and I want to make sure that this recording, like the second webinar, is on place for people to listen to, people who have missed out on this one. Let's move on. First of all, let me start off by saying that this has been one of the most tricky, difficult, convoluted, I don't even have any words for it, trading environment that I've dealt with in a long time. I've always said, and I'm going to stick to this and I'll repeat it, that I do a basket approach of things. When I'm mentioning 5, 6, 7 different ideas, I take small positions on each one of them, maybe weight it a little bit more in the ones that I'm a little bit more convicted about, and you certainly know that from my verbiage, such as acceleration phase, you know, all kinds of charts and stuff that I show. And give or take, if 1, 2, 3 of them work out in a big way, which a lot of them have, and I'm going to show them tonight, then it negates some of the losses that we're taking on the other ones within the time frame that we are trying to trade those instruments. Now, what does that mean in simple English? In simple English, this is a fragmented market. And a fragmented market will not allow you to make money on all things at one go. We have different sectors which are moving at their own velocity and their own, because of their own economic issues, or catalysts, I should say. And within those sectors, there are stocks which are moving again in a very fragmented basis. On the technology side, we're seeing certain parts of the technology market, or I should say certain stocks of the technology market, which are moving very well. And then, and especially some of the older legacy companies, the Microsofts and the Yahoos and such. And then you're seeing the momentum plays, which are the $5, $10, $15, $20 movers. Sometimes go up, sometimes not. There's an old saying that I have written in my mental cranial space, and that says, life happens in between our grand plans. Well, trading happens in between our grand charts. Because the reality of the thing is, and this is one thing that one of the great articles that's posted on the members' site, they should read, what is written by the esteemed Siam Shogun about risk, that we can construct the most amazing chart setup, technical setup for a trade, and given and on a certain day, given a certain market, it just doesn't work out. And even though it might work out, you know, at a certain point, it doesn't work out on the time frame that we're looking at. Well, that's exactly what's going on, happening in this particular market that we're talking about. Number 3, or maybe I skipped 2, I'm not sure. But anyway, follow me what I'm saying. We have a market where we have where we have a large number of very smart institutional fund managers and hedge funds, which I've repeated a zillion times, that are severely underperforming. Here's the problem. We're not quite sure on what particular areas they're going to do their beta their chasing, or their performance chasing or window dressing for the end of the year. In other words, we don't know exactly what stocks they have on their list, on the wall, that their traders are going to go gangbusters on a certain day to move it up, add alpha, or excess returns, whatever you call it, by chasing the high beta stock or high momentum stocks. In other words, taking the stocks that are going to move big to put in their portfolios to enhance their returns. So we're not sure exactly which ones are going to do that, right? So therein lies the stock selection picture. So even though we know for a fact that when we look at the HFR returns, which I, by the way, posted on the end of the day report the other night, we can clearly see that they're underperforming the S&P 500, which is up about 12.5% for the year, which is the holy grail that they need to beat, and they're far from it. That they're underperforming the S&P 500 or the market indices and the Vanguard 500 and the Jack Bogles of the world by a good 7-8 800 basis points, if not more. That's 7 to 8%. So, fourth thing, maybe I'm getting the sequence right here, right, is the fact that the intense 500 futures, as we're talking, they're down about $1.25. The intense involvement, or I should say the malicious involvement of algorithmic HFT programs during the day convolute a good portion of our well-planned trades during the day. So unless you're very quick, take your profits along the way, and even sometimes when we take our profits and we turn around and these things are going up another 20, 30, 40%, I'm talking about the weekly calls or the monthly calls, so it's a very frustrating event. I do understand everyone's frustration because I've gone through it myself on the losses that they take, and sometimes they take the losses, then they turn around and see, and which is a bigger, what should I say? It's far more painful when you take a loss and you turn around and you see the same trade work out in a huge fashion. It's happened to me. So I understand very clearly when over the last couple of weeks, especially over the last 2 or 3 weeks, where we had some huge winners in a bunch of stocks, that if some had held all the way or held at least parts of it and sold along the way, American Airlines, okay, and a few others that I'm going to mention. And yet, we have had the Netflixes of the world, the Googles, the Pricelines, which on certain days have rewarded us big time, but in many days they have basically screwed all of us up. So in other words, what I'm trying to get at is understand the pain and the frustrations and the suffering of traders. Because remember, traders are different than investors when they're trying to trade an extremely volatile market, and it's just so frustrating to see what they do. Here's Facebook that we left for dead, and now on a streak. And if it breaks out over, I don't have the Facebook right in front of me, but if it breaks out, let's say over 77.5 or so, and it's I think it closed at 76.36, we could be looking at 80 to 82 new highs. The last high was 81.16. I've been saying this for a while now. Yet, I didn't get into Facebook till what, 2 days ago? But then yet, we run into, we go in and we trade, and we get into a trade, we see that spike, we see that big candle, we see the large volume come in, and guess what happens 15 minutes later? Boom, a reversal, a large block sell comes in. That is the algo and the HFT shenanigans that we cannot control. So what I'm getting at is I have no answer for that. You have to basically manage the trades as quickly as possible, and I get these emails once in a while, and rightfully so, that hey, you know, I need a lot of these swing trades. Well, I can show you a lot of swing trades which I've said hold it, and they've worked out extremely well. Okay, the XONs, the SUNEs, you name it. Okay, Hertz is a great swing trade that we can just keep going, keep on buying the dips. So the point is that what I'm getting at is that sometimes we just need to, you know, we just have to deal with the risk, and I have no answer for that. So okay, so that covers, you know, the initial part of the thing. The second part of this thing, before I take the answer, and oh, by the way, before I go any further, did that make any sense? I'm looking for some responses here on the. Did some of the stuff that I talked about make any sense? Okay, I got 2. Jim Dabrowski says yes, good. Well, you gave me the yes, it does. Okay. One of the members said I lost my control panel. Yes, sounds like a good trading day. Somebody's asking where should we respond? In the question section Yes, just where you're, that's where you're asking. Yes, go ahead and just respond there. Okay, good. The second thing I'm going to talk about, very importantly, aside from the volatility and the craziness that we have to deal with on a daily basis, is trade size positioning. Very, very, very important. Everyone has a certain amount of money that we trade with. Even in my most bullish circumstances, I have not put more than 40% of my capital at risk. Yeah, I've gone like certain time, like 60%. But there's always 40% in cash. Because the way I look at it, and it's a law of numbers, geometrical progression, arithmetic progression, whatever you call it. There are a lot of smart people out there to explain that. The reality of the thing is that when you take that 60% and you can get it up to and get another 60% on that, then you're well ahead of the game on your overall portfolio. So trade size matters. I'm a firm believer, given the stage of the market that we are in right now, there is no sure thing. Because every night that we're going into a trade and we're holding any overnight positions, we have absolutely no idea. I don't care how, where the market closes, how great the news was on a Monday. We have no idea what's going to happen on a Tuesday, 9:30 a.m. when we open for business. In fact, we have no idea what's going to happen even by looking at the futures. The futures could be up a gazillion points. Could be up 10, 15 points pre-market. Market opens at 9:30. Guess what we see? We see the gap sell, which is number one discipline that I follow. We see anywhere more than a 6, 7, 8, 10-point gap open, sell. Or sell a good portion of it, put some trading stops, because you know what? You always sell open gaps up. You buy open gaps down. You buy open gaps down depending on what the news factor is and what the reasons are why we are gapping down. Generally speaking, a market doesn't gap down 10, 15, 20 points and continue immediately unless there is a major crisis or a global crisis that's unfolding. That generally happens for two reasons. Number one, a large war-like situation, such as what we encountered in the Ukraine-Russian thing. Okay? It didn't even happen in the Israeli-Palestinian conflict, because that to us is not a matter of important security. If something happens to Saudi Arabia, you can bet your you know what that we're going to fall 20, 30 points fast on the S&P. But generally speaking, if we start to see a 10, 20 point down, if you have a short, you cover it, and you look for some buys at that level. And that's what we've consistently seen as we go forward, right? I mean, as I've seen, and so far it's worked for me very well. So a big gap up, you sell, or sell a good portion of it, and a gap down, you do the opposite. Trade size. Got to keep your trades to a smaller level if you're going to carry things overnight. And I know it's frustrating because a lot of the times, you know, we don't hold enough things overnight, and then we see a gap open and we're like, oh my God, I wish I had more. Let me get some responses back. What I'm talking, is that relating to what, you know, what we're all going through? Okay. Dale, hold your questions for later, because then, you know, it's going to, somebody's saying it's reassuring to hear you say all that. Well, I'm human. I'm not an algo, okay? And I just keep in mind one very important disclosure, full disclosure that I want to make. I don't read out of a script. I'm standing here in front of my 10 screens in my corner here that my lovely wife has designed for me as my control panel, okay? And I'll show it to you guys all one day. I got Bloomberg TV on the back running. And it's all unscripted. This is the real deal. This is not some scripted stuff that's going on, you know, trying to sell you a bill of goods. I'm telling you what I go through. My year-to-date returns are pretty damn good. I actually went over all the numbers over the weekend. I normally don't like to look at it till at least sometime in end of December, but you know, every month when I look at it, but it's okay. So I'm glad that it's making some sense to you, because we're all going through the same thing here. So trade size does matter. Keep your trades a little bit smaller. If it goes, it goes. I'm going to show you a bunch of charts. We're going to blow your mind away because we've all gone through it. Now, we haven't held it from point A to point Z. Those 3, 4, 5, 6, 700% returns. My point is very simple here. Keep at least 5% running in the game, because after you won all that and on those runners, keep a little bit of the profits in there. You're playing with house money, right? And it's good to do that. It's good to do that. I keep on getting these calls from Angela Merkel, and I keep on telling her I can't take these calls because she's got to do what she's got to do. Which, by the way, she has very good news. You know, the majority of Germans love what she's doing, which means German QE is coming. All right, all jokes aside, let me move on. Okay, somebody, again, keep your questions for a bit later. That's a very good question that I just saw. And somebody saying, I'm very happy you're teaching us. I don't know what I'm teaching because I'm learning myself, okay? This is the real deal here. That's why I call myself Clueless8. And the joy of life is that you need to learn every single day. You have to be honest with yourself, and you have to keep in mind that the biggest strength in life is that we don't know all the answers. And that is going to make you a great trader. I've gone through it. I know it. I'm far from being a great trader, but I know one thing: I beat the pants out of most people out there. Okay, so let's move on. So trade size is one. Risk quantification is a very difficult game because, and this is a very important point that I want to dig in, so everyone's rapt attention. This market wants risk. I back tested a whole bunch of trades where I was a little bit too cautious on taking the trade or didn't take enough. Well, guess what? It was a unmitigated disaster. I should have taken the trade. I should have gone in those calls and price line at the bottom, which I did, but I sold too early. I should have taken those the Twitters at what was it, at the lows, like 29, 30 bucks, which I did. Sold too early. Moved in again. Still made money. But what about if I held it? Let me change the screen so people have a few visuals. Let me get my other mouse here. So let me just show a stock which is languishing at the bottom right now. And let me put it out here. And let me put a weekly chart of that. Here. Let me go back to my thing here. I was showing Twitter at these levels. In fact, I was showing Twitter at these levels, at the 40 level. I made a big name for myself. Go to Stock Twits and you can scroll back and you can see it. Stock went to 74. I sold mostly out at this level, around the 57. How great did I feel when it went up another 20 points? I didn't feel any good. As a peak performance trader, you're always looking to get 90% of the meat in the middle. Doesn't happen. As long as you get more than 60% of the move, of this type of move, okay, you're fine. So what I'm getting at is this market is about aggression. The Federal Reserve Bank and the central banks of the world want risk on. Yet, even as bullish traders like as a bullish trader that I am, which has served me very well so far, and there will be a time that I'll be, you know, on a consistently bearish for a limited period of time. I cannot be a dogmatic bear. It's not in my genes. The point remains that the market wants you to take risk. So if you're going to take that risk, take it with a small amount of money that you can lose in a nanosecond. Only then will you win big. Without risk, you cannot make those 600–700% type of returns that I've shown quite a few times in this over the past couple of weeks. You have to take the risk, because when it's a sure thing, what did Warren Buffett once say? I love that saying. You pay a high price for certainty. By the time it's certain what the trade is, keep on showing different things here. Okay? By the time it's certain what the trade is, you're not going to make that 300% type of return on the weekly calls, because by that time, it's a very simple behavioral game theory thesis. By that time, everybody's in the trade. By the time, StockTwits and then the rest of the forums are screaming, buy, we're in there, it's great. Hey, the herd mentality is fine, because the herd mentality can take you up another 20%. But to make that 100, 200%, you got to be ahead of the herd before the rush starts. That's the same thing, in life and in trading. So what I'm expressing to you from the bottom of my heart is that I have left more trades which have netted, I won't even get into the figures, high 5 figures, low 6-figure type of trades, okay, where I have left a significant amount of money on the table because I did not have the, cojones to keep the original large position in. And why is that? That's because on a daily basis, the volatility is so intense that despite my conviction and the charts and the things that I follow, I did not do it. So I can't really explain to you. There are no rules to it. So you have to manage your own mental and monetary discipline to figure out how much you want to leave in that trade as it's moving forward, even if it pulls back, what it does. And I'm going to show that to you on the different options charts that I'm going to show in a couple of minutes. Did that part make sense? Okay, I got one yes. My boy, Mr. Fuckerson, he's my brother on the bear side. Love it. Okay. Okay, that's good. I know I'm repeating the same things. You guys know better. You guys are a lot smarter than me when it comes to managing money, I'm sure. I might be better at managing charts and trading and stuff, and I'm sure you guys, a lot of you are very good at managing your own fiscal discipline. I'm good, but I'm not that good. So it's just the way it goes. All right, so those are the trade stuff. Now let's talk about a little bit of the macro global economics, what's going on. And I know I talk about it, but I'm going to try to make it concise and listen to it. Look, there's some big stuff going on here. Remember, man changes at the face of an abyss. I didn't make that up. It's an old saying, right? So the same thing happens. And what's the old other saying about the U.S.? That Americans love to try everything till the end, till they do the right thing, and they always get it done. Well, that's a fact. Winston Churchill said that. Well, something of that nature. That we like to go ahead and try a lot of stuff, and if it doesn't work, at the end, we do what works, and it does work. And you know what? That's why America is what it is. And that's the reason why we have to believe in our exceptionalism. And believe me when I tell you that given the global undercurrent of what has happened over the past couple of months and over the past couple of years, our energy independence, our lower dependence on oil, major factor, we as Americans not understanding the fact that we have truly, in many cases, become a large engine of growth for the overall global economy. I know there are economies which are growing a lot faster. There's India, there's China, there's Vietnam, there's Cambodia, there's Bangladesh. All these other peripheral economies are moving a lot faster. They're growing in excess of 5, 6, 7, 8%. But it's the law of numbers. They have smaller GDPs and they're moving faster. China's a different story. Their GDPs actually, in years are going to catch up with us. But there's a lot of different nuances within the numbers which really doesn't equalize to what we are. Okay, so on a macroeconomic standpoint, this is what I'm looking at. A lot of stuff I can talk about. I want to go into it because I can go on and on and on. Number one, we have a global liquidity infusion going on by every single central bank that we talk of. I talked about it 2 years ago, and I remember putting it down in StockTwits that at one point, and I didn't make this up, and because all my readings and my analysis in my head, that's what I came up with, that we're going to pass the baton of QE or quantitative easing or central bank buying of sovereign debt, as corporate debt, in our case is mortgage debt and treasuries and such, to the Europeans. Well, that is the process that we're going through right now. If you listen to my video cast from April 15th and onward, when I first started the service, you'll clearly hear, and I know some of you remember it very well, that I said that we're going to have a turbulent period as we end QE around the September-October timeframe. I don't have a crystal ball. That October generally is a turbulent month to start with. Guess what? We had that turbulence. We had a 10% drop, almost a 10% drop, and God knows a 20% drop in some of the sectors, and stocks went down 30% in the middle of October. Well, guess what happened? They talked about the Hindenburg Omen. They talked about everything else that was going to go wrong. Nobody talked about the fact that that we could actually that was the correction that we're looking for. Well, guess what happened after that? Well, I don't need to tell you. So, pulling up the S&P here. Take this out. Can everyone see the charts? Okay, because after this I'm going to show the charts and stuff, and then we're going to go over a few things, and I'm going to entertain the questions so this is the weekly chart. Where's the monthly? Bingo, starting all the way down from the devil's number, 666, right? 666.79. See that? Back on March 9th, October 9th. How do I remember? Because I was on Wall Street at that time. I should know. I was losing clients right, left, and center. So we have come a long way. There was a chart that I did on the S&P where I talked about, where I showed some very funny stuff, where I think some people might remember, where it showed like, your wife leaves you, the Dubai crisis, and like, oh, Dubai is the best. CNBC couldn't keep talking. They kept on eulogizing and going nuts about how great Al Jumeirah was, and what was going on with the Palm Oasis, and I mean, it was like crazy, and America was finished. Garbage. And we've come a long way from that, right? So the bottom line is that if I draw this, kind of from the bottom, this is where we broke out. What did we break out? We broke out around June of 2013. This is what you call the acceleration phase. Can everyone see what I'm drawing? Okay. Acceleration phase, right? There you go. This was the big crash, right? From, let me draw this, put some pictures in what I'm saying. This was October 2007. The crash of 2007 to 2009, that was compared to the worst financial crisis since the depression of, it's almost like a megaphone pattern, of 1929. And this is where we are. This was the breakout level, right? It took how many years? October 2007, and then March of 2013, if you really think about it. So it took 2007 to 2013, almost 5.5 years, about 5.5 years, for us to really break out of this nightmare that we encountered since 2007. So if you really think about it, since 2013, we broke out March of 2013. We're looking at end of 2014, so we are a year and a half, a little bit more than a year and a half into this breakout. So if you really think about it, is that too long from really getting out of the mindset of that this nuclear winter has ended? Well, not really. So this correlates with what I talk about. If you notice a number of news events, and again, this is the heavy-duty game theory stuff that's coming out, okay, that are shot out into the market at the end of the week. The Germans are considering sovereign debt purchases. The ECB Mario Draghi is going to unleash massive QE. In other words, he's going to keep, which is very unique and revolutionary for the Europeans, because they are in their mandate, in the central bank mandate, and you guys probably know this, they're not allowed to print money like we are. So for them to go out there and buy sovereign debt or corporate assets, but sovereign debt simply means debt of other countries. And you know, there's a lot of countries in the European Union. So if they're going to go out there and buy really crappy Greek, Portuguese, or Spanish debt, then they got to make sure that the rest of the rich European nations are happy about it, because they're the ones who are going to be funding it, such as the Germans, the Swiss, the Finnish, you know, the Danish, and the Scandinavian countries. Well, guess what? You notice how these news stories start coming up as the markets are breaking out? It's all a grand plan. So what I'm getting at is that if anybody's expecting a very large bear market type of scenario over the next, let's say, month or 2 months or so, I don't think that's going to happen. Simply because there are bigger forces than you and me can ever think of that are going to make sure that this escape velocity that we encountered here in 2013 and on a near-term basis, and I've showed this before, the megaphone pattern, if you remember. Let me try to show this, and it is. Okay. So this level here, this was around November 5th where we broke out. November 5th, yeah, around November 5th of just a month ago, month and a half ago, that this pattern that we broke out of, this is what we call escape velocity, right here. Okay, this is escape velocity. Once we escape out of it, this is when a rocket is launched, the NASA Orion. It reaches orbit, it starts to move on its own. The booster rockets fall off. Well, guess what the booster rockets were? That was QE. Well, QE fell off. And guess what was supposed to happen? When QE fell off, we were supposed to crash and burn. Well, we had turbulence. We did. We had turbulence. We fell, what, 10% on the Dow? And, you know, was that before or after QE? I can't remember. When did QE end? I'm going to put up another screen and check that out. QE ended. I still have the last promo thing here. Mind you, I'll wrap this up and I'll take questions, so have some patience. Let me see here. I'm putting this up on another one of my screens. QE ended October 27th. Well, guess when we bottomed in the market? October 15th. So the bottom line is that I did mention that that was the time we were going to have that readjustment. And then we had the massive drop in oil. And that's another thing I'm going to cover in a quick second, so you have to understand why the volatility in the market comes from in certain days. So here's the bottom line here. And Bernanke mentioned this a long time ago. Once we have escape velocity, this is escape velocity, okay, when the rocket gets into orbit, it doesn't mean that you're not going to see some fluctuations unless we break below 2017 or 2010 on the S&P. You can write this down, okay? Or let's say 2000 on the S&P, and we fall hard below that. And in my opinion, fall below, there's always an overshoot. So if we overshoot and fall below the 1990 level, let's say, okay, 1990 here, around this level, we're okay. But if we break below 1990, and God help us, if we break below, where's the line here? 1 second. See this hammer reversal here? I'm trying to show you a lot of things that Okay, hammer, right there. See the pink triangle, rectangle? So if we break below, let's say 1925, see you later. You can basically rest. By the way, this is a wide gap, so we definitely want to play that if we're going to breaking these levels here, right? So if we break below, let's say 2000 and 1977, one second, I'm trying to draw this as I'm talking to you all. Okay, right here, okay, 1977, 1960, we keep on breaking below those levels, and then we break that final straw, 1926, you can rest assured we are going to drop hard into the 1800s and, you know, take out this. That is a calamity, well, on the short side for the bulls. But aside from that, we are in escape velocity, and they are going to try to hold this as much as possible. Look at the Chinese market. Let me move on to some more macro global stuff. The Shanghai market, which they don't even talk about that much, right, is up huge. I look at the Shanghai market and I'm thinking to myself, why the heck isn't VIPS and Baidu and JD and YY and QIHU and Win, why not going through the roof? Maybe because they're traded here in the U.S. markets. Because the Chinese Shanghai CSI is moving in leaps and bounds. The Chinese are basically having a field day. The mom and pops of the Chinese economy, who used to basically trade the market like it was an early morning, you know, dim sum breakfast. Well, they're back at it again. Look at the Japanese market. Are the Japanese housewives back again playing currency futures? I have no idea. But I know for a fact that when you look at global market, they're going berserk. Look at the Indian market. Since Modi came to power, the Indian market is up a frigging 40-some% up. It kills me. Not because India's, you know, not a fast-growing economy and stuff, but should they be awarded a 40% premium on their markets? No. We're barely up 12.5%, and every morning we wake up scared, excuse my French, shit. That's what I'm getting at. Is the fact that we still have room to move where we can still have this type of thing. So on the macroeconomic front, there's not a lot of things that are going wrong. Yes, there's a lot of, the weaker the numbers get right now, the stronger the case for larger capital infusion and economic growth policies that are going to be put into place in Asia, in Europe. Those are two things that matter. Oil. Let me move on to the third chapter before we take questions. Are we, is anyone bored yet? I want to hear a couple of yeses or no. Or is that making sense? I know one of my favorite members, Mr. KC, is laughing his butt out, so that's great. Okay, great. They're not bored yet, given the fact that there are 3 people in the seminar. I'm just kidding. Okay. Move on to oil. Initially, when oil started to fall, I thought whole hell was going to break loose. If you look at my charts and stuff, and I looked at, I drew some really nasty pullback scenarios. Remember? I'll have news for you. It didn't work. I lost on the IWM puts, lost on the short, on the few shorts that I tried to do on the indices. Didn't work. Does that mean I completely give up on the short side? No. But that means I'm not going to pursue the short side at this point. Simply because of undercurrents in the market, and I'm going to try to show you another chart. If I can pull it into one of my on one of my screens here, as to the swing 533 charts that I rely on making some swing trade decisions. So the thing is that when it comes to oil, it truly looked like it was going to drag the whole market a lot lower. Well, it didn't. Let me pull up the oil chart here. And that was a big thing, because the fact that, whoa, 107 down to 65. What, can somebody just tell me quickly what the percentage of that is? Percentage decline? Quick, let me see before I do it. Wrong. Well, that was good, though. See, if you're an SAT test, you'd be getting actually 100 on that. It's 39%. Well, 39. Let's call it 40%. 40%. There you go. Okay. So there's a 40% move here. And this is a large component of the S&P 500. Energy, for God's sakes. and the market did not collapse. Now, the first thought that goes, why should it collapse? Oil's cheaper, everyone's benefiting, you know, it's great, you know, it's going to be great for the U.S. economy. Yes, I understand the macro picture. We all know that. You don't need to be an Ivy League graduate to figure that out. But the fact remains is the underlying credit structure of what's built on. The U.S. shale boom that has gone on for the last 6-7 years, was a good portion of it was financed by high-yield bonds, low-rated junk bonds. Nothing wrong with that, because a lot of them were the old-fashioned wildcatters, except it was shale that they were wildcatting. Okay? So they needed to borrow money at high rates, and Wall Street was all ready for it. They gave them some nice premiums for it, and that's what most of the money managers went for, to get those high yield returns or higher interest rates on their high risk investments. Well, guess what? At one point, when they can't finance their operations, they have to shut down their projects. Well, that's a calamity. And that is one of the reasons why we had that October 15th pullback, because we did have a major turbulence in the high-yield market where the credit spreads on the high-yield bonds went berserk because they weren't sure what was going on. Well, guess what? All that was managed. We realized that the high-yield HYG is the one, you know, if you want to look at it, the high-yield right here. The HYG on a daily basis, by the way, all these zigzag lines, that's think or swim zone thing. So if you put it up here, look what it says, the green zone, right? From in the green zone. Down here is a low. Look what the green zone is telling you. It's going to go to 93.5. So the high yield was at 95 at the peak. Let me look at the monthly. On the monthly, it was 106. That was back in May of 2007, crashed and burned, the financial crisis. So this was the financial crisis. Let me draw this. I'm showing you a lot of broader pictures here, things that I look at, little snapshot. The big financial crisis. The recovery from 61. Oops. I actually had these lines drawn here. One second. See these? That was, I had drawn it, when was this? Back in, there. I had drawn this back in May of 2013, or June, actually, of 2014. HYG is a great indicator if you want to look at. If you see the HYG, this is the high yield corporate bond ETF. Very good proxy to understanding what's happening underneath the surface. When that tsunami is coming, when a tsunami comes, it starts at the bottom of the ocean, and the ripples that pick up, and then the waves hit it. Okay? Want to learn that? Just, you know, YouTube the Discovery Channel. Well, the tsunami in the markets happened because of credit. That's what happened in 2000. That's what happened up here. Okay? And none of us, you know, well, we kind of knew, and I actually did pretty well for my clients during this period. That's another day's story. But this is the tsunami. The credit spread started widening, things started to move, and then came the ultimate bang, 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 right? And that's when man changes at the face of an abyss. Well, this was the abyss, and that's where it changed. So what I'm getting at is that you do the Bollingers here. If you see the HYG breaking below, let's say on extreme basis, 87, 86, 78, if it breaks below this, you can rest assured it's going to come test this level here, which is 78. You can stay short for weeks in a row. Okay? At this point, we had a minor break. We held this low. What was this low? That was October 1st. This is a recent low here on December 1st. So let's monitor that very closely. Now here is what's happening on the internals. Getting quite oversold. It did get massively oversold at around this level back in September 1st, 2011, and then comes October 2011. It actually went a little bit lower, but look where it ended up. Look where the stochastics are. We're almost there. We can go a little bit lower. So again, there is a risk that this hasn't bottomed yet. So what that means is there's a risk that the market certainly hasn't bottomed yet. So if we start to slip on the HYG, and do use that as a proxy, okay, as the underlying barometer of how your heart rate is, okay, or what your health is, or true health, then the HYG is one to consider. So oil, so far, at this point, if we break down to this level, 33, and believe me, there's always a possibility, because if we break 60, there's nothing here on a technical basis not to stop us from going to 33. In that case, you know what's going to happen? That's the flip side. Everybody and their you-know-what grandma is going to buy every single Raptor. I'd love to buy a Raptor, by the way. My wife loves a Raptor. You know, very, very huge. You know, it's a fantastic truck, right? And every gas-guzzling European import with a strong dollar, and you're going to see a huge boon in consumer spending, because they're all going to think that oil's going to be at $2 or $1.50 a barrel. I mean, $1.50 a gallon. And that's what's going to happen. But what's going to happen to the underlying credit situation on the junk bond side, on the high yield side? That is going to be the question. So again, there's a balance between that. But the fact that we have some semblance of rationality in the high yield market, it's good for the market. It's still something that needs to be monitored. So on the global front, we're okay. You're going to see a slew of announcements coming out of Europe, Asia. Global growth is picking up. Chinese, I think I just saw right now on Bloomberg TV that the Chinese trade surplus was very strong, so that's great. And hopefully we can bang out some sort of tax reform deal or not do anything really stupid on Capitol Hill. We're good to go. Enough of me. Before I move on to questions and answers, I'd like to ask one quick thing here. Did that make sense? Before I go to questions and answers, I'm going to just show a couple of charts on the options ones, the big winners. Okay, we know what the losers are. I'll show you some of the big winners that hopefully we took advantage of in a big way. But before that, can I ask if some of the stuff that I talked about made some sense and was worth your time being on here tonight? Okay. Okay, give me a quick second while I set all the charts up. So take a sip of your glass of red wine. All right, hold on one second. Okay, ladies and gentlemen, let me go over a couple of things that we might have taken great advantage of, and this is some of the charts that's going to make us very happy in some cases, and in many cases it's going to make us cry. So get your tissues ready, okay? Let me start off, this is a little sampling going back to October 30th. Let me pull it up on the screen. Chart of Bank of America. Okay, this was something that was recommended. I kind of try to keep track of all these things because I don't keep a running track of my trading portfolio. That's something that's coming, things that I recommend. So anyway, this was BAC October, and then the 17 calls. Buys were recommended at these very cheapo levels. Look where it went to. What's the return on these type of things? Do the math yourself. Let's even call it from 12 cents. Forget about 6 cents. From 12 cents to 35. You're looking at a 200% return on your money. Okay, so that's out of the way. Let's move on to the next one. Amazon. Did extremely well on that, okay? This was before it actually happened. So I'm not sure if I had the actual chart. Yeah, I think I do. We're actually recommended around the buck 17, buck 35 level. The big spike, the huge call. You know, I pointed that out. Thing really went from buck 50 to $4. In fact, it went higher, beyond the 50% fib. If I remember correctly, it went to $13. I wasn't there, I'll be honest with you. I sold out mostly at between this and 7. But hey, that fed my family and the cats and the dogs, right, that I have to manage. So there's Amazon. Let me move on to Baidu. All right, good one here. Baidu, again, recommended at 2. When was the date? The date was October, November 10th. You can always go back and scroll and see. These are all things that I've replayed, okay? Now, here's what I'm trying to get at. Let me just interject for 1 second here. When something like this happens, you know, we buy here. It keeps on moving sideways. I keep on saying, you know what, everything's okay. What's my favorite line? The chart is intact. I have no idea. That's what I think. You got to, you know, everything when you go in the trade, you got to go with your conviction. Like I said, every man or woman has to have an opinion. If you don't have an opinion, then don't be a trader. And that's all. That's all it is. So here we are. It comes here, and I'm sure people got, you know, nobody should have got stopped out because I recommended it here. And again, you know, my usual 60% stop thing, because I just put it out there. Sometimes I don't even listen to my own thing. Most of the times I win, some of the times I don't. So then you have the huge move up, right? It goes from 2 to 5.5. Oh boy. Sometimes I show my wife all this stuff and she goes, holy cow, right? But she's not a stock market person, so it doesn't matter. So there's Baidu for you. Where did it land up? 827. How long did it take? From the 11th, from a Thursday to a Monday afternoon. End of my case. Let's look at Amazon calls again. Recommended here on buck 361. These actually went a lot higher. I hope I recorded them. How long did it take? This was a Friday. This was a Monday. This was when I bought Amazon, right at the bottom. We all know this. Let's take a look at Amazon. Oh, by the way, let me stop myself because I don't want to be an idiot. I'm just a quick reminder, but I will entertain questions in a second, but let me go over this stuff so just so you all remember, like, you know, what we went through. So I don't want to rub, you know, salt on wounds or people who didn't hold it, but I'm sure it's a little bit helpful, okay? So hold off on the questions because I'm going to lose track. All right, so there's a lot of them here. So what was the one? The EOG. 1 second here. I think a couple of our cats are fighting. Hold on 1 second. Okay, that was the animal rescue distraction. I do apologize. We have 5 saved animals in the house, 3 beautiful cats and 2 gorgeous dogs, okay? So I had my office door closed. Do apologize. Sorry about that. Okay. So EOG, again, same story. Let me see you some recent ones. December 2nd, December 4th, BAC. Okay, yeah, BAC. Kept on saying buy BAC. This is a good one. 500% return. Monday through the end of the week. Now, I held a bunch of them because they were so cheap. 12 cents, bum. Did I sell at 75 cents? I absolutely did not. I sold that mostly around the 60, and in this spike up here, pretty much where I was out. So, just showing you some examples. Returns 500. Let's look at BABA. Well, this was actually the stock chart. Let me look at Netflix weekly, even on a crappy trade like Netflix. This was back on beginning of December 2nd, overnight trade, 300%. Overnight trade, ROI, 200%. Can everyone see the charts? Good. Now, the reason I'm reminding everyone about this stuff, in between the losers we've had, is the fact that these things can make the losers look insignificant. Netflix calls again, intraday ROI, 192%, and this was, let me see here, this is pretty, this was the 350s, and this was again December 2nd. All right, so I gotta show this. American Airlines, great trade. Showed it was going to pull back, did exactly that, and went straight up towards $52. And the calls, well, forget it. I don't want to even go into that. It's going to make you all cry. Get ready for this. I know I showed this. Okay, you ready? Bingo. $1,200% gain in 2 days. Did I catch 1,200%? No, I didn't. Did I catch a very large percentage of that? Yes. Okay? So that's a $1,000 that where it was going to go. $1,000 would have gone to $13,250. I rest my case. That would have taken care of a lot of your worries right there and then. Okay, so I just showed a couple of things here. Let me entertain some of the questions and try to see if I can answer them intelligently. So let's start off by, I'm going to scroll back and see, let me see the first question. Let me give preference to the people who have already asked the questions, even though they shouldn't have. Somebody asked, I've read to use no more than 5% of my account on any trade. Is that a good guideline? Yeah, depends. It all depends what your 5% is. If you're trading with a $100,000 portfolio, 5% is a decent amount. If you're trading with a $10,000 portfolio, then 5% really is not going to make you too much. So maybe you can move it up a little bit. So it all depends on your size. But I would say that you could trade, if you're trading with, let's say, I normally like to focus on 2, 3, or 4 positions at any given time, aggressive positions. So I would say that, you stick to about 10%. That's my answer. If oil falls, the markets go up, invest in retail and auto manufacturers. Yeah, well, let's put it this way here. When you think it's that easy, it's not that easy, right? So what I'm going to say is you got to be selective. Yes, I love this airline thing that I'm starting to do. I actually have traded American Airlines and Delta Airlines and United Airlines before, but now I'm really focused into this because now they're in focus because oil is in focus. And these airlines, for the first time in 20 years, are actually going to show a massive profit because oil's down. They're not reducing prices. They're still charging a heck of a lot if you're going to carry the second baggage. Their profits are going to be humongous going to the next quarter. So when you look at American Airlines, I wouldn't be surprised if you see this baby back in the mid-60s. which is huge. That's about another 13, 14, 1,500, even 5,000% on those on the calls. So we got to keep an eye on those things here. I don't want to be flippant about it, but that's a fact. And these airline analysts, you know, these guys are all boring farts, and all of a sudden they're like the big heroes in the market. And I think that's where a lot of the money is going. Okay. Okay, let me see. So in the short term, we may be bullish, but in reality, this could go bearish. What is the time frame on the short term? I have no idea what you're talking about. Can you explain? It says, yes, so in the short term, we may be bullish, but in reality, this could go bearish. So please explain what exact security you're talking about. Can you revisit the megaphone pattern in the SPX? That's where it looks like it's breaking out to the upside. I want to know if you view it as significant as the DJI megaphone breakout. I absolutely do. That's what's called escape velocity. They're not going to basically let that go to waste. And I'm going to show that if I can find it. And right now, I don't know if I have it right in front of me, but I'm sure you have the chart. The answer to your question is yes, I do believe the megaphone pattern is a reality, escape velocity, and at this point we will go forward. Question, for a low-risk person, if I buy your recommendations and the stock shows as a weak link in your EOD report, it's usually better to sell immediately or soon. I'll be very honest with you. If you're a low-risk person, I don't want you trading. Because if you're looking for low risk, there is nothing called low risk in this market. Because even the safety stocks, the blue chips, are high risk. So if you want low risk, I should say you stick to these American Airlines, you stick to the SUNEs, you stick to Hertz, you stick to FDX, you stick to those type of stocks that I recommend. You can even stick to Bank of America. You know, low risk to that certain degree that it doesn't move around like $2-3. But low risk is kind of an oxymoron when it comes to the market that we're living in right now. And that's not my saying. That's just the way the market is. Is it weak link in your EOD reports? Is it usually better to sell immediately or soon? That's a very good question. It's a question that I deal with every day. I have to measure my buy or sell moves based on what I see, and even sometimes what I see doesn't make any sense. Let me pull up the chart of the EOG, and this is what I'm going to tell you on a monthly basis. This you're going to love, because this is what you guys pay for being in my service, okay? Very few people are going to show you this. This is EOG. This is a monthly chart, for God's sakes. Forget weekly, forget daily, forget 15 minutes, forget 30 minutes. You want low risk, Guru? Look at this. You put a stop here on this baby at around 84 if you're buying stock. And you should buy some stock on this. At this point, I'm looking, this is a beautiful, this is very nice. This is telling me, again, oil's been hammered to kingdom come. Oil's not going any. Yeah, it might slip a little bit lower intraday and stuff, but there's way too much at stake here. Their economy is at stake. There's the Saudis at stake. The Iranians are at stake. And these guys are not kidding around. They've got to feed their population, okay? At this point, oil could slip down to about 77. I doubt it. I think on a monthly basis, we have reached some sort of intermediate bottom, and I think we could be looking at about 90. On EOG, we could be looking at about 96, that's 6 points and higher. So you want some sort of, again, low risk. I hate that word low risk. Look at the monthly chart. There's all buys, right? Look at the monthly. Look at another thing that's going on here. Look at this. The stochastics are starting to turn. I should put about $1 million in this stuff. Okay, I'm kidding. I do not have a Saudi cousin or an uncle, and I don't have an oil field. I work hard for my living. So, but okay, we're going to put a couple of $100,000 if we were a fund into this baby right now. Because once this turns, can everyone see this here? Scroll down. Can everyone see this? Okay. Casey Novak is excited. I like this. Okay, can everyone see this? All right, good. So, I am going to do the oval here. The famous oval. We used to do that back in the Wall Street days. The famous green dot. See this green dot here? If this green dot, this line crosses over, you can rest assured that on a monthly basis, we are basically going to blast through 96 and go above 101. That's a lot. In the comments, it's a very nice return. And on the options, it's a great return. So you want something reasonably great to play with, a macro play? Oil, EOG, ConocoPhillips, COP, PXD, you know, and find some of your own. You know, just go in there, go to Finwiz and type in oil and, you know, go to Investors Business Daily. But I'm just giving you the idea. This is a great sign. Notice another thing here, very importantly. We are starting to see, this was the capitulation. This was the capitulation right here. This was seller exhaustion right down here. We're starting to come up. Do I expect oil to be volatile? Yes. Do I expect it to go up? Absolutely. That's your answer. Okay, you mentioned YYVIP, Baba. Okay, no, I use your charts by monthly calls instead of working. In the last 1 month, some of the calls have gone underwater. Example, Netflix, Google. Should I use 60% stop loss? Okay, good question. I can't answer that because Netflix and Google and these guys, you know, I have the best charts in the world. Honestly, my charts are really goddamn good. You know, I'm pretty humble and stuff, but I look back at my charts, I'm like, holy cow, who was the guy who did those charts? Do I follow my charts all the time between A to Z? You know, from point A to point Z? No, but I really can't answer that question. Because the bottom line is that I'd like to know what you advise as a beginner. Number one, I don't advise. I am not a broker. I'm not a financial advisor. I was in that business for a long time, and I don't like it. I just suggest. So, again, for a beginner, I would say, like I explained to you, the EOGs, American Airlines, that type of stock is a much better play. The Google and Netflix are too goddamn freaky, okay? It doesn't matter how great my charts are. Eventually, they'll work out. They will work out. But the question is, what kind of risk and time appetite do you have? Time frame do you have? So that's your answer. Okay, Mr. Chaco answers, you mentioned YYVIPS and Baba earlier and said, why aren't them flying up? Could you go into this, explain what might be affecting the prices, pushing this lower? I'm heavily invested in these companies and their short-term prices are falling. Okay, the reason you're heavily invested in these stocks are because your cousin likes them. All right, end of story. No, all right. They're great companies. But I'll tell you one thing very simple. We don't really know what the exact valuations of those companies are. Now, you're laughing because I'm a mind reader. You know, it's called Clueless game theory. By the way, I love him, by the way. He's just a very smart guy. My point is, these companies are great companies in the longer term. They will grow, you know, grow into much larger companies. But the question is, how's Wall Street evaluating them? They love them. But a lot of them are loving Baba more than they're liking, let's say, YY or QIHU. In fact, personally speaking, I've traded a lot of Chinese companies before. I used to trade Dang and Youku and all this stuff. So why aren't they up like 60, 70%, 80% more, given the fact that the Shanghai market is up a gazillion % over the past couple of weeks and have broken a 3-year downtrend? I don't have an answer. My point is that it's maybe it's the fact that fund managers are accumulating them big, and at one point they're going to let them go. I still believe they're going higher. So it's a question of your time frame is what matters. You've talked a lot about the January crash or a large pullback, but if you sounded just now that you do not expect any bearishness given all the macroeconomics, has your outlook now changed for January? The January situation, Mr. Watson, is not because of my overall outlook. It's because of the fact that it's called tax selling. Once, you know, a lot of people do not defer their tax selling for the year for going into January so that they can sell and defer their taxes for 2015. So that's what I think. So if you're going to gang rush into January, we could have the first couple of weeks in January, like, you know, printing some new highs, but we need to give some back. I personally like it. Let's put this. Let me put this in this framework. Okay, let's put this in the framework. Imagine the whole year like a day that starts off in the market that starts off at 9:30 a.m., which is January. Wouldn't you like a nice dip first thing in the morning so you can start buying around 10, 10:30, 11 o'clock, European market close, and then by the time 3:30, 3:45, 4 p.m. rolls over, you're at the highs? That's exactly what the market's all about. So if we have a nice sell-off in January, like we did, then we set up the nice, we set up a nice year going forward. So I don't know, think about it in that way, all right? If we have a nice washout in January, allows us to basically sit back, buy some of this stuff, let the tax selling and all that stuff get over, deferred tax selling, I should say. Remember, there are wash sales involved too, where they sell in December and then they buy in January, and then we move forward. So that's the answer to your thing. I do, if we, depending on the, I mean, look, we are pretty high up there in the market right now. Let me, again, I'm going to pull up, where is my, I'm trying to find things here. Okay. I'm going to pull this up here. So look where we are. Dow Jones Industrial Average. Can everyone see this? Okay, good. So look at this where we are. I mean, just look at it simplistically. Forget all the technicals and all the garbage that we talk about all the time, and So, and then I'm going to show you some internals. I explained this in the video card, but tonight it's going to be more fun, right? So hopefully, like I said, have a nice glass of red wine, have your beers, and sit back and listen to this, to the Clueless rants. So here we are. We're in the top of this trading range. I drew this a while ago. I drew this, I didn't draw this in 2011. I actually drew this somewhere around 2013. So look where we are. We are right there on the top of this channel. But here is where the nuances come in. This is where the value-added PGT, right? Things I make up, predictive game theory. Look what I'm watching. I'm watching this baby here. I'm watching this fat line that I am going to put in green, and this fat line that is already in green up here. Look what this acceleration band is. Actually, let me put this in this so we know. Okay, this is the Bollinger Band. The Bollinger Band showing me 18,250. Upper Bollinger. We can get there. We're 17,958, 959, right? Where are we right now? We're right there on the green line here, which is the acceleration band. So can this acceleration speed up to 18,250? It sure can, because this, any technician will tell you, regardless of their cognitive bias and what they think, and whether they think they should be hiding in a bunker with a lot of Uzis and M16s. The bottom line is that that this is showing that this is a bull flag. If you were just a technician, you say this is a bull flag. I'm buying. No bias. So yeah, can we get to 18,250? Absolutely. Can that happen by December? Maybe. Well, can that happen by first week in January? Sure. Will we have a pullback? No question about it. Why do I say that? Very simply. Look at the standard deviation here between, I'm trying to find a line to show this, between the 3450 and where we are. Standard deviations matter. It's called reversion to mean. Everything has to come back to its, VWAP, mean, average true value, whatever you call it. It's like a big party, right? You have a big party, you feel really great. You can't be high all the time, right? You can't be that drunk. You got to come back sober so you can get to work tomorrow morning. Or you need to come back to sober so you can have your breakfast and, walk straight. That is what it's all about, okay? So maybe for people who are like, really, bought hard here, that was back in October, right? 15,830. Whoa, forgot where we were at that time. And now we're at 17,958. Well, yeah, we're going to overshoot a little bit, most probably. There's a lot of late come. They didn't buy it here. They all bought around here. They bought this breakout here at 17,380. They didn't even believe that. This was a breakout right here. And then this bull flag here. So again, for the guys who bought right at the bottom and held on all the way, and I'm sure there some of them are, they're pretty drunk right now. So they got to get sober. So sobering means that we got to come down. I believe we do test 17,356. Let me draw that line right here. And I've shown this before, 17,350. That's about 658 points. Whoa. I'm sorry, 600 points. 600 points of the Dow. We didn't think the world's falling apart. I would love it. So, and hopefully we're short at that time. By the way, very, very important, so everyone wake up. These things do not happen in the middle of the trading day. 90% of the time, they happen while we are sleeping. So unless you're a futures trader and watching the market like a hawk all through the night, and you're playing futures, you will have no time to react. Just keep that in mind. This is a manipulative market, it always has been, and the big players like to play while it's sleep time in the United States, because it's the Asian markets, Australian markets, the European markets when they open around 4 or 5 a.m. in the morning. That's what dominates it, and that's what overflows into our markets by 9 o'clock. Does that make sense? Okay, and that's a very important point here. Okay, we always think like in the middle of our trading day we're going to see a great correction. No, it won't happen. They'll fool all of us, which has happened a zillion times, and that's why I say the closes don't matter anymore, because they paint the closes, paint the tape. Painting the tape means they'll do something just to make sure these big market makers, the Goldman Sachs of the world and such. Hopefully Mr. Blankfein is not listening to this webinar. I like you, Mr. Blankfein. You're a nice guy. And he doesn't look like my uncle. So the bottom line is that they're the ones who dominate the trading arena, and they're the ones who make sure that these things don't happen in the middle of the day. So, you know, like I said, algos and HFT and the larger investment banks want to make sure that they are not that we're not present when the big moves happen. Oh, by the way, very important. Everyone focus for a second here. You see this move here? This has no signs of abating yet. I've shown this before on the video cast. And by the way, I'm not doing a video cast tonight, so this webinar is going to be the report. So this one, for example, you know, big OBV. Look at these strong moves. These are thrust. These are big. The Kopak curve, strong. I showed this on the webinar the other night. These are powerful. We got to sit back and, you know, not say, oh, it's overbought, oversold, because overbought can stay overbought. And it's a thrust that doesn't just come down that easily. These are punches, sucker punches to the bears, the dogmatic bears in the shorts, and they want to take them down. They need a technical knockout to say that we won. After that, they could sit back, let the market pull back a little bit, but they want that TO. That's it. Which tools like that bell curve? I like that bell curve pinned on Twitter. Are we really where your arrows are pointing? I have no idea what you're saying. I like that bell curve pinned on Twitter. Okay, let me try to pull Twitter on this chart here. Here's Alta. Did great on the common. The calls lost 40%. What a joke, right? So that's what happens. Thank God for that. That was Alta Salon. I played the earnings reports. Okay. Let me take all the drawings out. Bell curve. Where do you see the bell curve? I'm not sure. Live Twitter feed. Okay. Let me show you Twitter's chart, okay? This is the weekly chart. Twitter is really a freaky stock, honestly speaking. And I still don't know how to use Twitter that well, other than posting some of the stuff here. So let me just show, let me do a live thing. But I still think Twitter is going to be a major moneymaker. We did well in Twitter when we play it, you know. When we played it from the short-term lows here. So let me draw this here. This is what I see. This is definitively a technical breakdown. And I believe Twitter would be a screaming buy around the 36th level. I hope that happens sooner than later. Now, this is a weekly chart. This is a weekly chart, okay? Can Twitter get down to 29, 80, 30? You know what? It sure can. But I can assure you that there's some big players looking at Twitter and saying, we want to buy that whole infrastructure, lock, stock, and barrel. Let's get down to where we think it's going to be cheap. What's Twitter's market cap right now? Twitter's market cap right now is 24 billion. Am I right? Yeah, I think I'm right. I'm looking at my other screen here. So if Twitter's market cap comes down to 20 billion, you know, or if the Bollingers are down here, this is a difficult chart on a monthly. Let's take a look at the hourly for traders. On an hourly basis, Twitter could have a possible bounce. Could. So difficult to read this baby, okay? We do have a positive divergence. What is a positive divergence? For once, I'm going to explain this clearly. Well, I've explained that before too. We have a low here, and we have it here. When we had the low here, which was similar to the low here, look where the histograms were. The histogram was down here, right? The histogram was at almost 0. Where is the histogram right now? The histogram is at 46. Can everyone see that? Okay, great. So, okay, great. So this is simply a simple thing that I use. And I realize one thing as time goes on over the years, and I've made my mistakes, and I've learned, and I've moved on, and I'm implying a lot of things that I've learned. Keep it simple, stupid. The KISS principle. You know, I still, to this day, can't figure out Elliott wave charts. Wave 1, 2, 3, 4, 5. Yes, I understand the bigger concepts. Let me explain to you why I'm explaining this. And I mentioned Tony Caldera because he's so smart. Well, I'll tell you one thing. You can be very smart and still lose money in the market. Ask Mr. Connecticut Hedge Fund Group, okay? What can I say? So I'd like to keep it a little bit simple. I mean, these things have worked for me well, and that's why I'm explaining it. I'm sharing it with everyone, with the world, okay? With all of you guys. So what I'm getting at for the positive divergence things has made a lot of money for me. So here we are. I'm going to draw this line. And at around 38, look at the positive divergence. The histogram was at 0. Histogram right now is at 40. So you got a 40-point positive divergence on the price coming down here. Now, if you just look at the chart, that's a head and shoulder. And that head and shoulder, you can measure it. This head and shoulder measures to, if it breaks the 38 level, here's 39, 39.68, 38.35, so about $1.30. So $1.30 from here, subtract $1.30 from 38.35, you're looking at 37. So you're looking at 37.30, right around here, where it drops to. Can it happen? It can sure happen. So it all depends on you looking at divergences and which one you give a lot more weighting to. Right now, Twitter's at a pretty key level here. Very simple. 38. 38.46. So that's it. Positive divergence, and that's okay. Couple more questions. It's around 9:36. I finally fixed my clock from the time change. I'll be open for a couple more minutes. Feel free to ask me. Or let me explain a couple of things if you guys have don't have any questions. I want to show Bank of America. Love this. What my friend Tango Foxtrot said. You little piggy, what do you say? government-owned institution. Well, there you go. There's Bank of America. Worst business accounts I could ever had, but hey, stock's doing well for us. Anyone out there? Any more questions? Okay, let me. You want something, Guru? This is for you because people ask me about something that I think is steady and good. So let me. Can everyone see Bank of America? Okay, great. So let's keep this simple. It's what I do. The touch points. Make it look real simple, right? It's never that simple in real life trading, but hey, it is when you look in hindsight. We have a crossover here, very important. The 50 has crossed over the 34. And where do I see? This is where Bank of America is going. The Bank of America is going to be 18 and 1850. It's also the Bollinger Acceleration Band. The stock's at 1768. Buy the cheap calls here at 35 cents. The December 26, 35, what did I pay for? Like 30 cents or something, a little bit lower. After rolling over, you'll get these off at $1. That's a 300% return on the money. I'm not asking you to go out there and, buy 1,000 calls of these things. Buy 100, buy 50, buy 20, and look what the returns are. This is a very powerful chart for the right macroeconomic reasons. There's a relaxation of housing rules coming out of the FHA, the Federal Home Fannie Mae and Freddie Mac, and the Federal Home agencies. And the bottom line is that Bank of America is the biggest beneficiary of that. They've settled with most of the garbage that they dealt with. And at this point, with rising interest rates, you're going to see this banks move. Financials are the biggest movers. FAS, XLF, you name it. So this one, if it crosses over 1820, and you have some patience, this thing is going to go over and touch the top of the barrel, top of the channel, top of the barrel of $21. That will be a 2,000% return on your calls. So if you want to swing this baby, buy a couple of weeks out and keep on rolling them out. Pullbacks, buy them. They're cheap. They're not going to break the bank. They're good. I'm doing it. Done well. This is the channel that I'm looking at. See this channel here? White right here, right here. So this channel needs to be broken at around 1806, which I believe happens this week. And going into the upper part of January, we should see an overshoot into the $19 level. So I like Bank of America a lot. Apple. Looks like a cup and handle. Let me see. Absolutely. It was a cup, a mini handle, and now a big bang moved. I love this candle. This candle is serious stuff. Because if you pull this up, and this is a simple chart on stock charts, okay, not the complicated one. So what do you see? See this big buying, right? This is institutional buying. 374 million shares. Gotta love it. Let's look at the internals. Not bad at all. OBV, on balance volume. Let's get this sticker. Not bad at all. Let's take a look at the monthly. Let's see going out a little bit what they're thinking. I don't think anyone knows what's going to happen in monthly's damn good. Okay? Monthly's damn good. Look at that baby. So, going back, draw this line here. Upper end of the channel is $22. This is going to $22, and if we have patience, we're going to have the biggest trade for the next 3 months. How about that? Okay? We'll sit back. We need to focus on these type of things. Let me see here. Let me show American Airlines. This was a huge winner. The original chart showed a box. This is a weekly chart. I didn't expect it to go like this, but then I'm an idiot. What do I know? This thing, the way it's going right now, you're looking at about $63. Now, it also happens to be it's in the top of the Bollinger and the acceleration bands, so it needs to get a little bit of rest. And I would like that rest to come down to about the 45 level, okay, which it didn't yet. So it came down to about 46.91, but if it comes down to the 45 level, this is beautiful. Look at this big, huge breakout. When you have a histogram like this and this OBV like that, what it's telling me, this counted last couple of times, this is massive. It's going to last for another week or 2 weeks. Let's take a look at the monthly. Monthly doesn't make any sense. Let's take a look at the weekly. The weekly is certainly getting overbought. There's no question about that. So I'd like a little bit of rest, but this thing is definitely a mover. Okay. Are we good? All right, great. So in ending, let me just say one thing. First of all, I truly respect everyone's support. I want to make one thing very clear. The service is not my primary income conduit. I'm a trader. I never wanted to start the service. I'm glad I did. It's taught me a lot. It taught me how to focus more. It taught me how to educate and teach people, which I used to do a lot when I was on Wall Street, except I used to get paid big time for that. Okay? Now I get paid somewhat, right? $60 a month for the service I provide, I personally think it's a bargain. If somebody interacted with me this much, right or wrong, but actually was there during the market and during difficult times and good times and did the video cast and did all that stuff, I'd be willing to pay a little bit more. I'm not asking for that. I'm not raising my rates. I just want all of you guys to go out there, spread the word, get more people in. We have a couple of hundred people in here. Not everybody's that involved during the day. Not everybody's a full-time aggressive participant. But you know what? We need to get the community larger. So my point is, the best is yet to come. I'm not going to sit here. I've taken my lumps, and we have had some attrition on some people who have gotten hit hard on certain things like Netflix and some of the trades and stuff. But you know what? You got to spread your wealth. You got to go out there, and even if you're playing with a small kitty, you got to spread it out. Okay? Buy 1 or 2 calls on small things. Don't have to go nuts, because those 1 or 2 calls can deliver 300-400% returns. And if they go belly up, you're not going to be out on the streets. Because when you get out on the streets because you bet on something that big, that's stupid. So that's all I got to say. In the meantime, there's a lot more to understand and read. This is a very dynamic market. I put some fantastic articles on Twitter this weekend. I want everyone to read it regarding the algorithms, regarding the volatility in the markets and such. And believe me, the stuff that you are listening here is the same morning meetings that they have in Greenwich, Connecticut with the hedge fund idiots, excuse my French, the hedge fund smart idiots who listen to the same stuff and still cannot make more than on average of 2% for the year. So that's it. Touch on Apple if possible. Absolutely. Okay, let me see here. Apple, Apple, Apple. I actually did have it up here. So here, my chart still stands. Okay, and this is from one of my most loyal and favorite members, Val the Gal. Okay, so again, hollow candle reversal, called it. I'm not taking credit for much. I'm just simply saying the Apple chart is okay. It's a different chart to read, mind you. Okay, so let me show you some positive divergences that that come into play. So here we are. This I consider to be an important level, 112.57, and then I could also be looking at a retest of the downtrend, breakout of the downtrend channel, which was here. So it could test down here, nothing to panic about, around 112.57. And if we fall into this channel, then we got to go short on a tactical short, in which case we are looking at around that 107 level. Now, at this point, I'm concentrating on the Bollingers and the acceleration bands. So let's see here. Here is the upper acceleration band. Let me see which one's which. Acceleration band should be green. Bingo. Acceleration band is here. This is the Bollinger band. So somewhere in between this. So if we break, we're almost down here at the bottom. the 114 level. So if we break this, and mind you, this is kind of pinched. If you look at it, it's kind of pinched here. The point is that this is fine. We are starting to see some money coming out of it because the OBV is starting to come down, and we have a red negative histogram. It could be year-end stuff, like people doing some tax selling, so you have to be careful. But again, if we don't hold 114, we're going to come down and test the 112 level, 112.53, aggressive buy around 112.31. This is the long-term 200-day moving average, and God forbid we break that, then we're looking at around 107. We need to be aggressively short at that point. But again, this hollow candle reversal level is 112.61. So let me keep it simple. 112.61 is extremely key. In the meantime, short-term basis, this is what I'm looking at, is the 114 level. I still have a few calls here. Nothing too aggressive. And if we get a reversal here, then you're going to see a bounce which needs to go up into this upper Bollinger acceleration, get over the 34, get over the 50. I didn't like the fact that it crossed below the 50 after touching the, below the 34 line, the orange line. Look at the 50. This is the spinning top, right? I keep on talking about this is spinning top. Not necessarily good. It needs to go up. And if it does this and it breaks out over, which I thought it would do, over 119.20, you can rest assured we're looking at new highs. Somebody said send SPY to 22.220 by end of the year. No, how about 210? You should be happy with that. I've shown that repeated times, and I'm going to show the SPY again right now. The SPY, the good old SPY. SPY is looking good here. We're starting to see, wow, look at that volume on Friday, right? This is an hourly. Hold on. This is the end of the day. Okay, daily was a reversal of this sell volume on the day before. We do have a negative divergence here we have to watch out for. We have a positive OVV, all kinds of mixed signals. Right now, we are almost at the top of the Bollinger, and the top of this Bollinger Band is on a short-term basis is 209. So we need to be cognizant of that. On the weekly, we are almost up there at 209. So we need to have a little pullback before we get up to those, towards the 211 level. What does the green candle that is full on the Apple chart mean? The rest of the candles are hollow. Okay, let me see. I'm not sure what are you talking about, the green candle that's full. If this is the one you're talking about, this is the hammer reversal. So that's a plus. It's before the arrows. It's before the arrows. Oh, this one. This one? This full candle actually was a negative candle. This was on the 21st. I really don't know what it means. This basically, in my opinion, from what I've seen before, not necessarily good. You need a hollow candle type of thing. Spinning tops are bad. A hollow candle, a full candle, and then basically, this you might want to look up on the candlestick patterns, Google it. Because after that, it closed at 116.77 that day. Let me see. So 116.77, so it was not necessarily good, and then it kind of pulled back for a couple of days and then went up. So in answer to your question, that's a very good thing. I'm going to look it up myself. I see a similar one here. I see a similar one here, right there, which means that we're going to consolidate for the next 5 days and then move higher. That's pretty much what it means, because a similar one I saw here at, I've been showing to you on, and this is really called pattern observation, observing the charts, or recognition. This was back on, when was this? 21st of October. So that's your answer to your question. So look, you always look to see what happened after that. We had 1, 2, 3, 4, 5, 6 days, and then it kept on moving higher. So that's the answer to your question. Okay. All right, going to wrap it up. And I'm getting word from a very smart person, which basically is saying that, like I said, it was a downside gap fill that day. How about that? There you go. Send to all. That's the answer. Anyway, last thing I'm going to show you very quickly is the RVX, actually the VIX. And if you look at the VIX here, very important, we're the lower Bollinger here on the daily. So the possibility is, and there's a positive divergence going on here, because the last time the histograms were their lowest was when VIX was at 1382, and right now the VIX is at 1148, and the histograms are still green. That is definitely a positive divergence, so expect a pullback this week. So any type of burp up that we see, we should be able to take some profits off the table, and be careful. Because remember, when it comes around the 15th, we generally tend to have pullbacks, right? August 15th, April 15th, the time tax day that we started the service, October 15th, November 15th, so December 15th could be that before we start the year-end rally. So let's keep that in mind. All right, so just wanted to thank everyone for being there. I think I've projected a lot of my crazy thoughts out there. Please bring some friends in there, let them sign up. We need more members, there's no question about it. And we'll be having more of these webinars, more specialized ones. And thank you. And good night. And the webinar is going to be there for everyone to access when and let your friends know that too if they want to hear it. Thank you again. Let's re-engage tomorrow, and God bless. I'm grateful to be in the USA. What can I say? And donate to the Wounded Warrior Project, okay? And that's about it. Thank you very much. Please put in some nice recommendations or testimonials if you like what you hear, and also the survey that goes out, but put in a couple of good, shout outs on StockTwits, and also on the testimonial section on the website, so newer people can see what you guys are hearing. Remember, it's not always about winning, because the winning does come after the learning and the education, and I'm here to provide both. Thank you very much, and good night.